Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Lara Rhame joins us. She's the chief economist at FS Investments. Lara, given some of the economic data we've seen recently, I guess most recently was the strong retail sales, it seems like this economy is doing fairly well, if not better than fairly well. How do you think about it?
I think what we're seeing is a little bit of a difference between the growth data that you alluded to with the retail sales numbers and the employment data, which does seem like the trajectory is slowing more notably. Okay. I think all of this adds up to a soft landing, but I think you bring up something really important. If you look at the GDP data, it still looks like there's no landing. We're still growing at a pace that's well above potential. And I think really reflects a consumer that just is truly unstoppable. When we look ahead, however, I think we are in for an incremental slowdown in GDP growth. We're probably going to see business investment take a pause. A lot of uncertainty right now about regulation around the election. And I think we're going to see government spending also downshift to neutral from being a pretty powerful tailwind. But you add it all up, I think today where you see the soft landing more specifically is in the labor market data, where we are starting to see a cooling picture. Not cold, but cooling.
Lara, you walk us through sort of how you're thinking about all of this. As you listen to Fed policymakers walk us through the way that they're approaching this next meeting, which is going to take place just a day or two after the presidential election, what are you listening for? I'll note that Chris Waller is speaking today, I think in Vienna, Austria. We're going to hear from Neil Kashkari as well. Is the commentary that we're getting, is it cacophonous? Are we hearing some of that unanimity that a lot of people thought was eroding after the last meeting? What stands out to you? What are you listening for when these policymakers speak?
I think the only thing that they're unanimous about is that they're going to have to be data dependent when they're looking ahead to 2025. Listen, the inflation data has absolutely come down enough to open a window of opportunity for the Fed to correct rates down and sort of keep them in line with real Fed funds rates. You know, when we see inflation coming down, just the nominal Fed funds rate starts to look a little bit more restrictive. So I think that's the adjustment that they're making today. And 225 basis point rate cuts at the next two meetings has always been my forecast. I think where I deviate more significantly is into next year, because I think they're going to really take a pause. They're going to wait and see how the economy is evolving. And I feel like they take flack for having this sort of data dependent view, but I think they have to, because I don't think inflation's totally gone. I think it's, I think the boogeyman's under the bed. I don't think it's just gone for good.
Lara, let's talk in the labor market here. From my perspective, this is a fully employed economy because all of the Sweeney offspring are gainfully employed. So to me, that's very good fully employed economy. What do the numbers tell you about kind of where the labor market is today and where there might be some risks?
It's interesting that it's evolved into almost a two-speed labor market, because when you look at the hiring data, it's declined. It's looking weaker than it was before the pandemic, and it's eroding somewhat. But when you look at the layoffs data, it's also very low. So, people aren't losing their jobs en masse, which is really just what's so critical to keep household consumption going and consumer confidence where it is. But when you look at job opportunities, clearly that churn that we saw after the pandemic is really gone now. And you're seeing the hiring side of things looking cooler. But, to me, the canary in the coal mine is always the weekly initial jobless claims. We are seeing some elevation there because of the hurricanes that have devastated some local communities. But overall, outside of that, they're still fairly low. And of course, nothing gets the market's attention like the monthly payroll report, which I think is going to continue to show a steady unemployment rate at around 4.1%, and hiring that's strong enough to keep that unemployment rate steady where it is.
Bearing in mind what you're saying about how the Fed's going to be data driven and we have to be as well, let me just ask you about some of the softer data. And we had that consumer confidence number a few weeks back, which I think spooked a lot of people, consumers less confident in the economy, where it is now and where it's headed. How do you factor that into the way that you are forecasting and thinking about the economy, just the sense that consumers have about the U.S. economy directionally? I noted in the last Conference Board report, this sort of heightened interest in what the Fed is doing and where interest rates are going.
You bring up such an important point because the consumer confidence data have been lackluster, have been weak really since the pandemic. And that's despite, a very strong labor market. And despite the fact that while consumers say they're a little more downbeat on the economy, they're still out spending like gangbusters. So it's hard for me to connect those dots today, given that the data has just sent such mixed signals. We read the consumer confidence data closely because it comes out early. But of course, what really matters for all of us is what their consumers are actually doing, not what they say they're worried about. That said, we cannot just ignore it. So it's something I think that I'm hoping will get better after the election. I think that's weighing on sentiment, just the uncertainty. And I think that, as consumers slowly get used to interest rates at a higher for longer place, some of that concern around what they're able to afford, and what houses they're able to buy is going to normalize a little bit. I just think a lot of people are waiting for us to come back to a very low rate environment. And I don't think it's going to happen.
All right, so I'm not refinancing my mortgage is what you're telling me anytime soon. Lara Rhame, thanks so much for joining us. Lara Rhame, Chief Economist at FS Investments.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I want to bring in Nancy Curtin, partner, Global CIO, head of investment advisory at AlTi Global. Hey, Nancy, we're just kind of getting into the teeth of the earnings, but we had some good numbers out of American Express today. The big banks put up some really good numbers. I mean, Morgan Stanley, JP Morgan. What do you take away so far from what we've seen coming out of corporate America earnings-wise?
Okay, so we're early innings in the third quarter, but so far so good. Banks, as you said, were pretty strong. Trading, they're benefiting from the volatility in markets. We think investment banking will probably pick up. And I think they indicated quite nicely on improvement in net interest margins. We had Netflix overnight. TSMC rather dispelled the fact that there's a problem in demand for Gen AI. So I think that reads well into NVIDIA earnings. That's coming towards the end of November, as you know. Look, there's a low bar for the third quarter. Expectations are 4%. And I think companies are going to leap right over it. So we think this quarter will be strong. But really what's important for our clients and our positioning is looking ahead to the fourth quarter and 2025, where we still expect earnings to continue to accelerate as central banks ease.
Well, Nancy, let's talk about that as you try to look ahead to the fourth quarter. And obviously, there's an election between now and then looming large. And I'm curious just about kind of the panoply of risks that you see here. Yes, there's the election results. There's this Federal Reserve meeting that we were talking about just a few moments ago. I'm looking at just sort of how much gold has gone up in price here in recent days. How are you thinking about risk, and how is that kind of shaping your perspective as you look ahead to the fourth quarter?
Well, first of all, it's important to remain diversified, which is what we do. We don't just have equities. We've got things like private credit and infrastructure and gold. Gold, as you mentioned, hit 2,700 overnight. That's been a really, really nice diversifier and ballast in client portfolios. So it's not just about equities. And I think given the strength in market that we've seen already year to date, a pullback on any of those event type things and data things that you said coming ahead. We've got a PCE, we've got a jobs number that's going to be a bit mixed up with the hurricane and Boeing and so on and so forth. forth. And then we got the election, and then we've got the Fed. So, short term, you never know with markets could easily pull back. They've been super strong. But remember, last Saturday, we celebrated happy birthday 2-year anniversary. Typically when you make it to 2 years, you make it to 3 years, 70% of the time, and data going back to like 1949. And remember, the average length of a bull market in the United States is 5 years and 100%. We've done 60 in 2 years. So we got to look forward to 2025. And all things being equal, unless there's some big resurgence of inflation, Middle East upset, whatever, we are still constructive, positive on the outlook.
Hey, Nancy, we had some conflicting results coming out of some of the big chip makers over the last week. ASML had a little bit of a warning there, actually a big warning, let's be honest. But then Taiwan Semiconductor came back strong yesterday. As someone who thinks of the chip business as kind of a proxy for this whole AI trade here, I'm not sure if it's a trade or it's a long-term theme. How did you kind of deal with those two earnings announcements? How do you think about the tech space and AI, given what we've seen from the chip makers?
So look, ASML was a bit of a howler there, that's for sure. But, and we haven't gotten full clarification, but the press release from the company talked about the fact that it's really not in the AI side. It's more in what I call easier electronics, etc. Some weakness in end markets of where they sell some of their less advanced so-called chip equipment into. So we don't think that plays into at all that there's going to be weakness in NVIDIA. Jensen Huang has made it pretty clear. Demand is on fire. TSMC is forecasting 30% growth in revenue. So we think the Gen AI and demand for chips is very much alive and well. So much so that there could be some near-term shortages as we head into 2025 in components, chips, etc. And funny enough, before we get to the big productivity boom of Gen AI, we could have a bit of inflation that comes from these shortages. So something we're keeping an eye on.
Nancy, I think the last time that you and I spoke, China had unveiled maybe the first of these initiatives to kind of do fiscal stimulus, monetary stimulus. There was great excitement about that. Then that ebbed as there was some skepticism about what that actually meant and how China might implement it. We got these new growth figures today, which I think are on the low end for the last six quarters, but some more clarity from the Chinese central bank this morning. How are you looking at China as you kind of look at the investment landscape globally and processing what we've heard both from policymakers there on the fiscal side and monetary policy side?
So the good news is in China, it's kind of Houston, we have a problem, right? So finally, China is dealing with both the deflation and slowdown in the economy. But we believe the fiscal and monetary stimulus so far is not kind of in the Draghi school of whatever it takes, right? We think China probably needs $1.5 trillion of stimulus, fiscal and monetary combined, with an emphasis on the fiscal. They've done about a third of that, or at least hinted at something like that. So we don't think it's enough. More importantly, China has some big structural issues, right? It's got a very high savings rate. It's got an aging demographic, unemployment in double digit, and lack of a social safety net. So that is really a problem for consumption, particularly as a lot of those consumers put their money in the property market, which isn't doing too well. And then they've got a strategy for export growth, right? Let's be manufacturing renaissance, be the world's leader in manufacturing. The problem is if their domestic economy is weak, that creates excess capacity that they want to ship to the rest of the world. The rest of the world doesn't want it. And so that brings tariffs and trade tensions and the like. So look, we think there are some cheap Chinese shares. There is some value in the market. But overall, we think the combination of structural and cyclical, not yet dealt with by the Chinese authorities. But the good news is it's removed what I call the tail risk of China kind of dragging the world lower with it. So in that sense, the monetary and fiscal stimulus is a positive from an overall global growth perspective.
Nancy, thanks so much for joining us. As always, appreciate getting your thoughts and your perspective. Nancy Curtin, folks, she's a partner. She's a global CIO. She's the head of investment advisory at AlTi Tiedemann Global. Nancy's been on Global Wall Street for decades, and we appreciate getting her
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Our next guest, we need to get right to Gautam Mukunda. He's a lecturer of management practice at the Yale School of Management. He's also the author of Picking Presidents. Gautam, thanks so much for joining us here on our studio. I don't think anybody knows how we're going to pick this president come 3 weeks' time. What's your view of this election, these campaigns, kind of where we are today?
Always a pleasure to be here. Anyone who tells you they know what's going to happen is immediately demonstrating that they do not know what is going to happen. Right. So when people say it's too close to call, that's basically true. I think the Harris campaign seems to feel that they'd rather be them than the other guy. Mm-hmm. I observe that the Trump campaign seems to feel that the Harris campaign is right because they're acting in a few ways that don't seem like someone who thinks that they can tip it. Trump has pulled out of 4 interviews, major interviews, CNBC, 60 Minutes in the last few days. That's kind of striking and surprising for 20-some days to go to an election. But the other thing, that the big change that has happened since Harris came in, and this is an incredibly static race since she came in, right? All these people, the polls are swinging. No, they're not. This is just stable. The big change is there's been a convergence in the swing states. When Biden was the candidate, he had a path through the Midwest, and that was it. What's happened since Harris is that Arizona, North Carolina, they've all kind of converged. And so you do have this odd prospect where what is objectively a very close race could become not that close in the Electoral College after Election Day, just because all the swing states correlate. And
so they correlate for whom?
That's what no one knows.
Okay. Right? Yeah. All right. I just want to make sure I wasn't missing something there. Okay.
You bring up polling, and I wanted to ask you about this because it's something Paul and I have talked about off mic, and that is there are so many polls. We are getting so many of them. You look at them in complement. What do they tell you? How do you approach them? I know that there's so much skepticism about what they've said in the past, how they've been right and wrong. Here we have them at such a granular level. So much of what we know about these swing states comes from them, and we know kind of what issues are most important to voters. How much faith do you put into them, and how do you look at them kind of holistically?
Right. So the polling data in 2016 was actually pretty good. The estimate of the popular vote was only off by 1%. The polling data in 2020 was really bad. The estimate of the popular vote was off by 4%. What was bad in 2016 was the swing state polling, right, which is why the estimates as to who won were so off. But caveat to that, right now, the thing that makes me really question the polls right now is how consistent they are.
Interesting.
Just normal, right? Polling are statistical instruments. Normal statistical variation, you should see numbers that jump around all the time, right? If Harris is legitimately up 2%, let's say she actually is up 2%, you should expect to see a fair number of polls where Donald Trump is up 1%. Mm-hmm. We are not seeing that. We are just seeing poll after poll after poll coming in with roughly the same data over and over again. To me, that suggests that the polling companies are hurting. Nobody wants to
explain that. What does that mean when there's hurting in polls?
There's a lot of judgment involved in how you weight different populations, how you assess, right? Are you going to use recollections of how people voted 4 years ago? For example, a lot of polls will ask, how did you vote 4 years ago, and use that to assess, to re-weight their sample. The problem is people don't actually remember that as well as you think. If you ask people a few years after the race, who did you vote for? On average, more than 60% will say they voted for the winning side.
You blocked it out.
This seems unlikely, yeah. So when you add in, there are enough subjective factors into polling that it just seems to me like the polling companies might be thinking that nobody wants to be embarrassingly wrong, and they're converging on a number which, look, it might be right, but it's not normal for it to be this consistent across all the polls.
One of the other issues that I think a lot of people are concerned about is we may not know the evening of Election Day who the winner is. We may not know the next day or the day after, and then, oh boy, it could get messy, and it's 2000 all over again, but on steroids. What is the risk there of that type of scenario developing?
Quite significant, but it also depends on your definition of no. Okay. We did not get the networks, who somehow we have outsourced the job of calling who wins an election to. We did not get the networks to declare until several days after the election in 2020. But by 11 p.m. on election night, I was texting people saying 100% certainty Biden is going to win. Like, I am, I will bet my condo right now, any odds you want, Biden's going to win. So we knew, right? We just didn't officially know.
Okay.
This election, I suspect, will look more like 2020, where we'll have a really good sense, just because I expect the swing states to correlate. I expect, where what we'd have to say is, well, there'd have to be flips in like multiple states to reverse it. That doesn't seem likely to me. But that doesn't mean that we'll have official knowledge, because if Harris loses, she's going to admit it. She's going to say I lost, and that'll be the end of it. But if Trump loses, I don't think there's any chance that he'll do anything other than claim it was stolen. He'll do legally, he'll do that, and then we're off to the races. We really don't have a great sense of what's going to happen after that.
We have been through this week when both of these candidates have made overtures to populations you'd think would not be natural supporters of them. So for Kamala Harris, it's Republican women voters in Pennsylvania. For Donald Trump, it was going down to Miami to speak to this audience of Latino voters from the Univision studios there. I'm curious sort of what you make of that outreach that they're doing. And so when you look at the game plan going from here to November the 5th, should the game be to reach out to those undecided voters, how few of them there may be, or is it simply to focus on the get out the vote effort to make sure that those are committed to these candidates make it to the polls on Election Day?
True undecided voters, last time I was on, I said 3%. True undecided voters is probably under 2% at this point. We're talking about really tiny margins. A lot of what people are looking at, what seems like going to undecided voters, I don't think it's actually about that, right? If in North Carolina, Harris is going to win the cities and lose the rural areas. But if she cuts into Trump's margin in the rural areas, the cities will take her. Right? In Pennsylvania, it's the same thing. So what we're seeing is what might code as undecided voters actually, to me, looks a lot more like we're trying to do essentially a covert turnout, get out the vote margin in areas where we're going to get blown out. We just don't want to get blown out by that much.
So it is, I've heard from folks, a get out the vote kind of election. Does one side or the other have an advantage in that?
So from people on the ground in Pennsylvania that I talk to, that's where I've been focusing my attention. It certainly feels like the Harris operation is a lot more sophisticated. What we've seen is the Trump campaign has essentially outsourced their get out the vote operation essentially to Elon Musk and his super PAC. Obviously, that's lavishly funded. He put $75 million in just recently. But we don't see them on the ground. I'm not totally certain where this money is going, frankly. The question is that the Trump people have a theory of victory. And it is not a dumb theory of victory, right? This is not the amateur hour campaign that we saw 2016 and 20. These people know what they're doing. Okay. And the theory of victory is that they can get people who do not normally vote to vote for Donald Trump. If they're right about that, then they win this election. Okay.
Gautam, thank you so much for joining us
Great
yet
to
again.
speak with you.
Yep, great stuff. Gautam Mukunda, he's a lecturer of the management practice. Now, it's at the Yale School of Management. Now, he walks into Gautam with a very nice three-piece suit, but he's got this pin on his lapel. It's got the American flag, also the flag of Harvard. And you walk into your classroom at Yale with that?
The only time in my life I ever wear Harvard gear is when I'm on Yale.
Okay, very good. All right, good stuff there. We'd like to see that rivalry still in full tact. That's good to see.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Well, let's get a sense of this M&A business for the remainder of this year and kind of what the big banks are looking for next year. Carole Streicher joins us. She is America's Regional Head of Deal Advisory for KPMG. Carole, thanks so much for joining us here. Talk to us about M&A. In 2024, how's the business been for Global Wall Street? And then we'll talk about next year. But how's 24 been?
Yeah, 24 has been a better year than 23. We are seeing deals increasing in 24. We've seen them increasing. But, 23 was a really low year. So it's not a robust 24. If you kind of look at the last year that deal makers kind of look as the last year of normality was 2019. And 24 is still lower than 2019. So better than last year, but still not a super robust deal market.
I'll take the follow-up, picking up on what Paul said. So looking ahead to 2025, what engenders optimism in bankers and lawyers, in your clients, about how the market is going to look?
Yeah, I think the sentiment around from everyone we're talking to, I was with 150 deal makers yesterday talking about the M&A market. And the sentiment everywhere is that 25 is going to be a more robust year. And 26, we're talking about kind of the next couple years. And, there's a few things that we're looking at that are going to be, things that are headwinds and tailwinds in the deal market. Some of the things that are positive is interest rates, as you guys know, are coming down. And that is an important factor in deal making. The election hopefully will be behind us and some certainty will be back into the market. And I think that will be something that will also help with the M&A market. I think this next quarter, the remainder of the year is still going to be on the lighter side given the election. I think what deal makers want is that certainty. And so those are some of the things that we're looking at for 25.
Private equity, where are they in this deal market here? I know there's just tons of capital on the sidelines for these private equity folks. They're always in fundraising mode, it seems, but we haven't seen them maybe back in the market in the size maybe some of the bankers would like to see. Where is the private equity sector as a driver?
Yeah, you're exactly right. There is so much dry powder out there. The private equity firms need to put that money to work. And I think the thing that is most impactful that we see from a private equity perspective is the interest rates coming down. So especially those LBOs, those leveraged buyouts, interest rates needing to come down to be able to make those deals a little less costly for that cost of capital. And so when we did our M&A survey of deal makers, it came out very clear that in the first half of 25, PE is more bullish around having a more robust M&A market, driven again by those interest rates. It was interesting. Our corporate clients, in contrast, said that they thought it'd be the latter part of 25 where they'd be a more robust deal market for them.
I wanted to ask you about regulatory clarity. So you mentioned the election. It's this obstacle, I think, for a lot of CEOs as they look at the prospects of M&A. And I wonder, as you listen to these two candidates on the campaign trail, how thorough their policy on regulation seems to be. So obviously we've lived through a Trump administration before, and even though Vice President Harris has tried to draw a distinction between what her presidency would be like compared to the one that she's in now with under Joe Biden, do we have a good sense of what the regulatory environment would be like under each of these candidates?
Yeah, so here's what I would say is that there has been increased scrutiny from an antitrust perspective for several years. It's not just been within this administration. And I think that as we think about the future and what we're hearing from our clients is that scrutiny is not going to go away in the next term of whoever's in office. I think they're working closely with their lawyers to assess what scrutiny might be there for that in particular deal, and working closely on that. And so that's what I would, there's not a clear one path leads one way and one path leads another way.
Carole, if I want to go out and buy a company, who's going to lend me the money? Because I'm going to want to use some leverage to leverage my equity returns. Are the banks still there, or where am I going to get the money?
Yeah, absolutely. Great question. You can only get deals done if you've got the money. So a couple things. So clearly, for those that are using debt to finance the acquisition, the banks are open. If you rewind, around 6-8 months ago, that was not the case. And so there is money out there. It's a little bit more expensive than it was, several years ago. But it is available. And there's also the opportunity for some of our corporates to be using their stock, as well as they're flush with cash on their balance sheets as well.
Let me just ask you, you talked about the Federal Reserve and the path of rate cutting, and I'm curious just sort of how catalytic that's going to be. So we've joked about refinancing mortgages in the housing market and all of that. In this space in particular, how much of a catalyst, how much did the dam break when you saw the Fed cut by 50 basis points, just kind of when we saw the start of what we anticipate to be a cycle of rate cuts?
Yeah, it's really interesting because when that rate cut hit, it's also all the election stuff is going on. And so it's hard to bifurcate, if you will, what's happening with the different things, interest rates and election. Because oftentimes in election years, we see a depressed M&A market. That's what we've seen for the last several election years. All that being said, your question is around those interest rates, and it is a catalyst for M&A. We haven't seen the dam break, if you will. We at KPMG, our chief economist, is predicting another 50 basis points drop, 25 basis points in November, 25 in December. And when we look at our M&A survey, what our deal makers said is that a 50 basis point drop would spur them into doing activity like it was in 2021. Now, this is deal makers who, that's what they do for a living, right? But they're
itching to get back in the game. Yes,
absolutely. I always say it's like a kid asking a kid in a candy store if they want a candy. Of course, they're going to say yes. Let's go.
Carole, are there any sectors, or what are the sectors that you think might be, or your clients think might be active over the next year or two?
Well, what we've seen so far is that TMT has been a sector that's been extremely busy. On the contrast, healthcare has been significantly down. We're starting to see that pop up a little bit from a sector perspective. But, of course, I think there's things around our energy needs, clean energy is another one where we're seeing some uptick in the deal market as well.
Carole, thanks so much for joining us. Really appreciate getting your perspective on the global M&A business. 24 better than 23. Expectations 25 might be pretty solid as well. That's certainly what we hear from the big investment banks that have reported their earnings so far. Carole Streicher, she's America's Regional Head of Deal Advisory at KPMG. Her clients are the big M&A bankers around global Wall Street, so it's good to check in with Carole and get a sense of kind of where her clients think this business may go.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.